This is one of the most read and most talked about books ever written about the world of money, trading, and the human mind. It is the story of a man named Larry Livingston, though almost every reader who has picked up this book knows that the real person behind the name is Jesse Livermore, one of the most famous and most dramatic traders who ever lived on Wall Street. The book reads like a novel, full of tension and energy and honesty, yet it carries inside it a treasure chest of wisdom about the stock market, about human nature, about failure and success, and about the price a person pays when they allow their emotions to rule their decisions. It is not simply a story about making money, and it is not simply a story about losing money either, though both of those things happen many times throughout its pages. At its deepest level, it is the story of a human being trying to understand himself well enough to survive in one of the most brutal and unforgiving arenas the world has ever produced, namely the financial markets of early 20th century America. The story begins when Larry Livingston is still very young, barely out of grammar school, a boy who was always exceptionally quick with numbers. He had a gift that not many children have, which was the ability to hold large quantities of figures inside his mind and work with them without needing to write anything down. At school, he completed 3 full years of arithmetic study within a single year, not because he was pushed to do it, but because numbers came to him as naturally as breathing came to everyone else. This gift would shape the entire direction of his life, though he did not know it yet when he was a child. His first job after leaving school was as a quotation board boy at a stock brokerage office. The job was simple in its description but fascinating in practice. He sat beside the ticker tape machine, which was a device that printed out stock prices on a thin strip of paper as transactions were happening across the exchange, and he called out those prices to the other boy who then wrote them up on a large board in the customer's room so that everyone in the office could see what was happening to the market. The prices came fast, and the work required quick eyes and a sharp mind, and Livingston had both. But what made him different from every other boy who had ever done that job before was that he did not simply pass the numbers along and forget them. He watched them. He absorbed them. He noticed that prices did not move randomly, that they had patterns, that they behaved in ways that could sometimes be anticipated if you paid close enough attention and if you had the memory to compare what was happening now with what had happened before under similar circumstances. He started keeping a personal notebook in which he wrote down his observations and his guesses about where certain prices were headed, checking later to see how accurate those guesses had been. At first, he did this purely for his own amusement and out of curiosity, not expecting it to lead anywhere in particular. But the accuracy of his guesses was striking, and it did not take long before a fellow worker noticed what he was doing and suggested that instead of just writing down guesses, he should put some real money behind them. There were places nearby called bucket shops, and these establishments were a defining feature of American financial life in that era, particularly in the smaller cities and towns far from Wall Street. A bucket shop was, in the simplest terms, a gambling house disguised as a brokerage. You did not actually buy or sell real stocks when you walked into a bucket shop. Instead, you placed a bet on whether a particular stock price would go up or down, and the house on the other side of that bet was the bucket shop owner himself. The prices you traded on were the real prices coming off the ticker tape, so you needed to read the tape accurately to win, but no actual shares ever changed hands. You simply put up a small amount of money as what was called a margin, meaning a deposit that covered potential losses, and if the price moved in your favor, the bucket shop paid you the difference. If the price moved against you, you lost your deposit. It was a much simpler and faster system than trading on a real exchange, and for a young man with an extraordinary ability to read price patterns from the tape, it was almost like being handed a license to take money from the house. Livingston walked into his first bucket shop with a tiny amount of money, a few dollars that he had saved up, and he came out with a profit. Then he came back and did it again, and again. His method was not random or impulsive at all. He was looking at the behavior of prices on the tape, trying to identify which direction a particular stock was most likely to move in the near term, and then placing his bet in that direction. He was not yet thinking about the big picture, about whether the whole market was going up or down, or about what a company actually did or what its prospects were over the coming years. He was focused entirely on the immediate price action, on the tape itself, and he was very good at reading it. Within a short time, he was making more money from the bucket shops than he could have earned in many months of working at the brokerage office. He became well known in the bucket shops of his city, and then in bucket shops in other cities, and then in more bucket shops across a wider region. He moved from town to town, placing his bets, winning consistently, and building up his savings. By the time he was 21 years old, he had turned his small savings into something in the range of $25,000, which was a genuinely large sum of money in those days, worth many times that amount in today's terms. But there was a problem growing alongside his success, and it was a problem that would define a major turning point in his life. The bucket shops were beginning to refuse him. Word had spread about this young man who kept winning, and the owners of the shops did not want his business anymore. A bucket shop made its money when customers lost, and a customer who kept winning was not a customer the shop wanted. They started refusing his bets, or they started limiting the size of bets they would accept from him, or they found other ways to make it difficult or impossible for him to place trades under his own name. He tried disguises and different names and other tricks to keep trading, but eventually the situation became clear. He had become too good for the bucket shops, and it was time to go somewhere larger. New York City was the obvious destination. The New York Stock Exchange was the real thing, the largest and most powerful financial market in the world at that time, and it was where the serious money was. Livingston arrived in New York full of confidence, carrying his $25,000 and his reputation as a young man who could read the tape better than almost anyone. But what happened next was one of the most painful and instructive lessons of his entire career. He lost almost everything. The system that had worked perfectly for him in the bucket shops did not work on the real exchange, and the reason was not that his ability to read the tape had failed him. The reason was that the mechanical realities of trading on a real exchange were completely different from the mechanical realities of trading in a bucket shop. In a bucket shop, when you saw a price on the tape and decided to act on it, you placed your bet instantly and at exactly that price, because the bet was purely between you and the shop owner and there was no delay. But on the real exchange, when you gave your order to a broker, that broker then had to take it to the floor of the exchange and execute it there. And by the time the order actually went through, several seconds or even minutes might have passed. In that time, the price had moved. What he called slippage was eating his profits alive. A pattern that in a bucket shop would have given him a profit of several points was giving him nothing or a loss on the exchange simply because the execution was slower and the price he actually traded at was worse than the price he had seen on the tape and acted upon. He did not understand this at first, and he kept trading the same way he always had, kept losing, and watched his $25,000 disappear into the market. He was nearly broke, which for a young man who had come to New York full of confidence and success was a deeply humbling experience. He went back to the bucket shops for a time, rebuilt his capital, and then returned to Wall Street with a much better understanding of what he needed to change. This cycle of going broke, rebuilding, returning, and learning would repeat itself several more times throughout his life, and each repetition came with its own set of hard lessons. What made Livingston unusual was not simply that he recovered from these financial disasters, but that he actually took the time to understand them, to sit down and think carefully about exactly what had gone wrong and why, and to extract from each failure something that could make him more effective the next time. He described his losses as tuition fees, payments he had made to the market in exchange for an education that could not be purchased anywhere else or in any other way. Most people who lose money in the stock market look for someone or something to blame. A bad tip, an unlucky moment, market manipulation, some outside force that caused their loss. Livingston was different in that he was willing to look at himself honestly and say that the fault was his, that he had made a mistake in judgment or in discipline or in timing, and that he needed to correct it. This habit of honest self-examination was perhaps the single most important quality he possessed, more important even than his gift for numbers or his skill at reading the tape. As he returned to Wall Street and continued his career, he began to develop a much more sophisticated understanding of how markets worked and how successful trading was done. He moved beyond the simple tape reading of his early years and began to think about markets in a larger and more fundamental way. One of the central ideas he came to was the concept of the line of least resistance. He used this phrase to describe the direction in which a stock price or a market as a whole was most naturally and powerfully inclined to move. Just as water flows naturally downhill and takes the path of least obstruction, prices move in the direction of least resistance, meaning the direction in which supply and demand are most unbalanced. When buyers are stronger than sellers and there is more desire to own a stock than there is willingness to sell it, the line of least resistance is upward and prices will tend to rise. When sellers are stronger than buyers, the line is downward and prices will fall. The skill of a great trader, in Livingston's view, was not primarily about picking which individual stocks would go up or down based on some analysis of their underlying business, but rather about correctly identifying the line of least resistance and placing trades in alignment with it, not against it. He described this in a very practical way, explaining that he would begin building a position in a stock that he believed was moving upward by buying a small initial amount first. If the price then rose as he expected, confirming that his reading of the tape was correct, he would add more to his position. He would only add to a winning position, never to a losing one. If his initial purchase was followed by a decline rather than a rise, he would accept that his reading had been wrong and get out of the trade immediately, accepting a small loss rather than letting it grow into a large one. This discipline of cutting losses quickly and adding only to winning trades was something he talked about repeatedly throughout the book, and it was something he admitted to violating on several occasions with disastrous consequences. One of the great themes running through the entire book is the gap between knowing what to do and actually doing it. Livingston knew perfectly well, from his earliest years of trading experience, that the first rule of surviving in the market was to cut your losses fast and let your profits run. He could explain this principle clearly and convincingly to anyone who asked, but knowing it and applying it were two very different things, because applying it required going against some of the most powerful impulses of human nature. When a position starts losing money, the natural human response is not to sell it. The natural human response is to hope that it will come back. You think to yourself that you are not really wrong, that the market has temporarily moved against you for some unimportant reason, that if you just wait a little longer, the price will recover and you will be proved right. This hope, as Livingston learned again and again, is one of the most dangerous emotions a trader can have. He described hope as the enemy of the trader, not because hope itself is bad, but because hope keeps you in a losing position long after rational judgment should have sent you out of it. The companion to hope on the other side of a trade is fear. When a position is making money, the natural human response is to become afraid that the profit will disappear before you take it. You want to lock in the gain while you still have it, so you sell too soon, before the real movement has run its course. The result of these two emotional errors combined is that losses are allowed to grow large while profits are kept small, which is the exact opposite of what successful trading requires. Livingston observed that most losing traders operated this way without even realizing it, driven entirely by emotion, cutting winners short because of fear and holding losers long because of hope. He had done it himself many times, even after he understood the pattern and knew it was wrong. The human mind, he found, is not naturally suited to trading well. It requires constant effort and discipline to override the instincts that evolution built into us for other purposes, but which become deadly in a financial market. The psychological dimension of trading was something Livingston returned to again and again throughout the book, and it is one of the reasons this text has remained so influential for over 100 years. He was one of the first writers to explain in plain language that the greatest enemy of the trader is not the market, not the manipulation by powerful insiders, not bad luck or incomplete information, but the trader's own mind. Greed drives people into positions that are too large for their capital to safely support, so that a normal market fluctuation that a more conservatively sized position could easily survive becomes a wipeout. Fear drives people out of good trades too early and keeps them out of markets during the very moments when the opportunities are greatest. Impatience causes people to trade when they should be waiting, putting on positions before the right moment has arrived, simply because they are bored or restless or feel the need to be doing something. Overconfidence follows a string of successes and leads to recklessness, to taking excessive risk at precisely the moment when humility is most needed. Wounded pride after a loss causes people to rush back into the market to try to recover what they lost, trading emotionally rather than rationally, and usually losing more. All of these psychological traps were things Livingston had walked into personally, and he described them in the book with the rueful honesty of a man who has paid a very high price for his education. One of the most important concepts he introduced was the idea of waiting for the right time before placing a trade. He was not talking about trying to predict the exact top or bottom of a market movement, which he regarded as impossible. He was talking about patience, about not trading until the conditions you were waiting for had actually arrived, until the evidence was clear enough that your confidence in the trade was well-founded. He described a specific kind of moment he watched for, a moment when a stock that had been moving within a range for some time finally broke out of that range in one direction or the other with enough force to suggest that a real movement was beginning. That breakout, confirmed by the tape and by the general market conditions, was the moment he wanted to enter a trade. He did not want to anticipate it by entering before it happened, because if the breakout failed to materialize, he would be wrong and would take an unnecessary loss. He did not want to wait too long after it happened, because the longer he waited, the less of the move remained to profit from. The art was in recognizing the breakout as it happened and acting at the right moment with confidence. This sounds straightforward when described in words, but in practice it required enormous discipline and patience, because there were always many moments that looked like the right moment and turned out not to be, and the temptation to act was constant. The hardest thing, Livingston said, was not to think but to sit still. To sit with your hands in your lap and your money in your pocket and wait, watching the market, reading the tape, understanding what was happening but not trading, because the time was not yet right. Most people could not do this. Most people found the waiting unbearable and eventually gave in to the impulse to do something, to make a trade, to be active, to feel that they were participating. And that impatience, that inability to wait for the right moment, cost them money day after day after day. As Livingston moved further into his career, he began to operate on a much larger scale, trading not just individual stocks, but attempting to move entire markets. He became involved in what are called pools and corners, which were coordinated trading operations in which a group of wealthy traders worked together to push the price of a particular stock in a chosen direction, using their combined capital to create artificial price movements that could be used to profit. This kind of market manipulation was not illegal in the early 20th century the way it would be today, and it was actually a fairly common practice among the most powerful operators on Wall Street. Livingston participated in some of these operations, sometimes as an organizer and sometimes as a participant, and he described them in the book with considerable detail. These sections are fascinating both as a historical record of how markets worked in that era and as a window into the ethical complexities of financial life. He was not entirely comfortable with all of it. He recognized that what he and others were doing in these operations was essentially deceiving the public, creating a false impression of demand or supply that caused ordinary investors to make decisions they would not have made with accurate information. But the culture of the time regarded this as simply part of the game, the way things were done among serious operators. And Livingston was too deep inside the system to stand outside it and judge it cleanly. What he did develop, however, was a clear understanding of the difference between this kind of artificial price movement and the genuine movement that came from real supply and demand in the broader market. Artificial movements could be created and sustained for a time, but they always ran out eventually. The moment the operators behind a pool stopped supporting the price, reality reasserted itself, and the stock fell back to where natural supply and demand placed it. Genuine movements, on the other hand, were backed by real economic forces, real changes in business conditions, real shifts in how much a company's stock was worth, and these movements could sustain themselves for much longer periods of time and travel much further distances. The skill of distinguishing between the two was one that Livingston worked hard to develop. He wanted to know when a price movement was real and when it was manufactured, because the strategies for trading each type were very different. In a manufactured movement, you needed to be on the side of the operators and get out before the support was withdrawn. In a genuine movement, you needed the patience to stay in the trade for as long as the underlying forces supported it, which could be much longer than impatience would normally allow. The biggest and most famous trade of Livingston's career, the one that made him genuinely wealthy for the first time in a really large way, was a trade he made on the short side of the market, meaning a trade that profited from prices going down rather than up. He had been watching the general condition of the stock market for some time and had concluded that the whole market was overvalued and headed for a serious decline. The time was around 1906 and 1907, when American business was booming and stock prices had been rising for a long time, and most investors were feeling very confident and optimistic. Livingston's reading of the situation was that the optimism had gone too far, that prices had risen beyond what the underlying business conditions could justify, and that a correction was coming. He began selling stocks short, which meant borrowing them and selling them with the intention of buying them back later at a lower price and returning them to the lender, keeping the difference as profit. Selling short is a psychologically and socially difficult thing to do in a booming market, because it means betting against the general optimism that surrounds you, betting against the confidence of everyone who is buying, betting that what everyone thinks is going well is actually heading for trouble. The social pressure against this kind of contrarian stance is enormous. People call you pessimistic or unpatriotic or simply wrong. Brokers who depend on commissions from buyers have little interest in helping you sell. Everyone around you is making money from rising prices and telling you how much they are making, and the temptation to join them and abandon your short position is very powerful. Livingston held his position. Then the San Francisco earthquake of 1906 hit, and the financial consequences of that disaster contributed to a tightening of credit conditions that helped push the market into the sharp decline he had anticipated. He was right. The market broke hard, prices fell sharply, and Livingston made a very large amount of money from his short positions. This was not luck. It was the result of careful observation, patient analysis, and the courage to act on his own judgment even when the world around him disagreed. But it was also, he admitted, not entirely his own doing. He had been watching and waiting for a market break that he believed was inevitable, but the timing of any market break is always uncertain, and it required a degree of fortune as well as skill for the timing to work out as it did. He was honest about that. One of his most consistent themes was that no trader, no matter how talented or experienced, could claim complete credit for every successful trade. The market had its own dynamics, its own timing, and its own surprises, and even the best trader was always operating with incomplete information and making probabilistic judgments rather than certain ones. After this great success, Livingston found himself with more money than he had ever had before, and with a reputation as one of the most powerful individual traders on Wall Street. For a time, he lived very well. He had a yacht, fine clothes, good horses, and all the other things that came with being a successful speculator in that era. But the money also brought new temptations and new dangers, and he made mistakes. One of the most significant patterns in his life was the way success seemed to generate the conditions for his next failure. When things were going well and he was making money, his confidence grew until it became overconfidence. And overconfidence led to larger and larger positions and less caution, until eventually something went wrong and the losses mounted faster than they would have if he had kept his head. He also had a weakness for taking advice from people he trusted, which in a speculative world was particularly dangerous. He knew, intellectually, that he should trust his own analysis and his own reading of the tape and nothing else. He had learned this lesson many times. But he also had relationships with certain men he admired or trusted, and when those men came to him with strong views about a particular stock or a particular trade, he sometimes listened. Almost every time he acted on someone else's advice rather than his own analysis, he regretted it, not because the other person was necessarily wrong, but because he was trading on information and conviction that belonged to someone else, not to him. When the trade started going against him, he did not have the deep personal conviction that would have allowed him to hold steady because the conviction had never really been his in the first place. He panicked when he should have held, or he held when he should have cut the loss, because he was second-guessing someone else's thinking rather than thinking for himself. He summarized this insight in a way that has been quoted many times in the decades since the book was published. He said that the only thing a man should act on in the stock market is his own investigation and conclusions. Tips and advice from others, no matter how well-intentioned or how knowledgeable the source, are dangerous precisely because they put someone else's reasoning inside your head in a place where your own reasoning should be. Another major theme that runs through the book is the relationship between money and freedom. Livingston was not primarily motivated by the desire to own things or live luxuriously, though he did enjoy those things when he had them. What he really wanted from money was the independence to operate as he chose, to take the positions he wanted to take, to hold them for as long as he judged necessary, and to act on his own analysis without being constrained by financial pressure. This freedom was repeatedly taken from him, not always by his own mistakes, but sometimes by the structure of the market itself. On more than one occasion, he found himself in a situation where he had a large and well-founded position but did not have enough money to hold it through a temporary move against him. When your broker requires you to put up more margin, meaning more money to back your existing position, and you do not have it, you are forced to sell regardless of whether your analysis is right or wrong. The market can move against your position temporarily, even when the long-term direction is exactly what you expected. And if you run out of the financial resources needed to survive that temporary adverse move, you are eliminated from the trade before the profit you had correctly anticipated ever arrives. This happened to Livingston multiple times, and it taught him one of the most bitter and important lessons of his career, which was that you must always have enough capital in reserve to ride out temporary adversity. Being right about the direction of the market but being forced to sell at the worst moment because you ran out of money is a particularly painful kind of mistake, because you can see clearly that you were right but you cannot benefit from being right. He learned to respect the practical realities of financial leverage and position sizing, not just the theoretical correctness of his analysis. As the book continues, Livingston deals with a series of large trades and complex operations, some of which succeed brilliantly, and some of which end in disaster. He makes a great deal of money in the panic of 1907 and rebuilds his fortune to a very large level. He loses large sums through bad advice and poor discipline. He gets back up, rebuilds, and trades again. This cycle of rise and fall and rise again is one of the most compelling aspects of the book, both because it mirrors the real patterns of financial markets and because it reflects something deep and universal about human experience. Very few people achieve lasting success in any competitive field without going through multiple serious failures first. The ones who eventually succeed are often distinguished not by some special talent that others lack, but by the persistence to keep going after failure and the intellectual honesty to understand what went wrong and change accordingly. Livingston had both of these qualities in abundance, even when he also had the weaknesses of overconfidence, impulsiveness, and susceptibility to advice from others. One of the passages in the book that has been most widely discussed and remembered is a section where Livingston talks about what it takes to really understand a market or a commodity, and he uses cotton trading as his example. He had begun trading in cotton as well as stocks, and he found that the principles were similar, but the specific knowledge required was quite different. Cotton prices were driven by the supply of cotton grown in the American South, and the demand for cotton from textile mills and other buyers around the world. To trade cotton well, you needed to understand not just the current price on the tape, but the fundamental economic realities that were driving or were about to drive that price. How much cotton had been planted this year compared to last year? What the weather conditions had been like and what they were expected to be, since rain or drought could dramatically affect the harvest. How much cotton was held in storage at various warehouses around the country? What the demand situation looked like from the mills? Whether any unusually large buyers or sellers were about to enter the market. All of this required genuine knowledge and careful study, not just the ability to read short-term price movements on a ticker tape. Livingston found that the kind of broad and deep understanding of a commodity's fundamentals that was necessary to trade it successfully on a large scale was very different from the purely technical tape reading that had served him so well in his early bucket shop days. He had to become, in effect, a student of the cotton market in the same way that a merchant who actually bought and sold cotton would need to be. This shift in his approach to trading reflected a broader evolution in his thinking about what markets were and how they worked. In his early years, he had essentially treated the market as a game with patterns that could be read from the ticker tape, and his trading was largely based on those patterns without much reference to the underlying economic reality. As he matured and operated on a larger scale, he came to understand that at the deepest level, market prices were a reflection of economic reality, of real supply and real demand for real goods and real businesses. The tape told you what the price was doing right now, but the underlying economic forces told you what it was likely to do over a longer period of time. And the most powerful and most profitable trades were the ones where the tape reading and the fundamental understanding reinforced each other. When both the technical picture and the fundamental situation pointed in the same direction, your confidence in the trade could be very high. When they pointed in different directions, caution was the appropriate response. There are sections of the book that deal with Livingston's relationships with other powerful figures in the financial world of his time. He interacted with some of the most important men in American business and finance, including figures who could move markets by their actions and who used their power in ways that were sometimes legitimate and sometimes not. He describes his dealings with these men with a mixture of admiration and wariness. He respected their power and their intelligence, but he also knew that their interests were not necessarily aligned with his own, that they might be friendly today and adversaries tomorrow depending on the direction of the market and the positions they each held. The world of big money, as Livingston understood it, was not a world of permanent friends or permanent enemies, but a world of shifting alliances and conflicts, in which today's partner could become tomorrow's opponent without any personal animosity being involved at all. It was simply the nature of a market, which was always a place where someone was winning at the expense of someone else losing, and the positions around the table changed constantly. He also described in detail the practical mechanics of running large trading operations in that era, including the way that big operators tried to manage the public perception of stocks they were involved with, using planted stories in financial newspapers and other forms of what today would be called information management to shape market sentiment in ways that served their trading positions. He was candid about the fact that a great deal of what was reported as financial news in those days was actually manufactured content paid for by operators who wanted to push prices in a particular direction. Tips passed along as if they were insider knowledge were often deliberately placed to lead unsophisticated traders into making moves that benefited the operators on the other side of those trades. This was a deeply cynical but entirely honest observation about the realities of financial markets in that era, and Livingston shared it not to celebrate the dishonesty but to warn the reader about it. One of the lessons he drew most forcefully from this experience was that a serious trader must never act on information passed along through the grapevine, through a tip from a friend who has a friend who knows someone at a brokerage, through a rumor overheard at the club or passed along in a letter. Not because the information is always false, though it often is, but because even when it happens to be accurate, it does not belong to the trader who received it. He does not know where it came from, whether the person who gave it to him understood it correctly, what other information would be needed to put it in the right context, or whether the whole chain of people who passed it along each added their own layer of misinterpretation. Acting on a tip is essentially handing your money to strangers and asking them to make your decisions for you, and the results are predictably bad over any significant period of time. The only reliable foundation for trading, in Livingston's view, was your own research, your own understanding, your own careful reading of the tape combined with whatever fundamental knowledge you had developed through real study of the business or commodity you were trading. Everything else was noise, and noise was not a foundation on which serious money could safely be placed. There is a very important section of the book that deals with what Livingston calls pivotal points, which are specific price levels or market conditions that he regards as particularly significant in indicating whether a large movement is about to begin. A pivotal point is not a precise price at which you should automatically buy or sell. It is more like a signal, a moment in the behavior of prices that tells an experienced observer that something important is about to happen. It might be the moment when a stock that has been declining finally stops declining and reverses, showing that the selling pressure has been exhausted. It might be the moment when a stock breaks above a level at which it has repeatedly turned back before, showing that the resistance at that level has finally been overcome and that buyers are in control. It might be a moment of unusual trading volume that indicates a shift in the balance of buyers and sellers at a key price level. The specific form of the pivotal point varies depending on the market and the stock, but the general principle is that there are certain moments in market behavior that carry more information than other moments, and the experienced trader learns to recognize and act on those moments while remaining patient during the periods in between. Livingston described his method of entering a trade at a pivotal point as involving a kind of test. He would put on a small initial position and see how the market responded. If the market confirmed his expectation by moving in the direction he had anticipated, he would add to the position with greater confidence. If the market did not confirm his expectation, he would accept the small loss from his test position and wait for a better moment. The key discipline was never to add to a losing position, because adding to a loss is a way of doubling down on a bet that the market has already told you is wrong, and it violates the most fundamental principle of capital preservation. Capital preservation, the protection of the money you have available to trade with, was something Livingston discussed with great seriousness throughout the book. He had lost everything multiple times, and each time he had lost everything he had to start over from a much weaker position, rebuilding his capital slowly and carefully before he had enough to make the kinds of large trades that were really worth making. He understood from this experience that the amount of money you have available to trade is not just a financial resource but a strategic one. With adequate capital, you can be patient, you can wait for the right moment, you can ride out temporary adversity without being forced to sell at the worst time, and you can size your positions appropriately for the risk involved. Without adequate capital, you are always vulnerable to being wiped out by a bad patch of luck or a temporary move against you before the underlying trade has had time to prove itself right. He advised anyone who was serious about trading to treat their capital with the utmost respect, to take losses quickly before they became catastrophic, and to never allow pride or hope or stubbornness to keep them in a losing position long enough for a small loss to become a large one. A small loss is simply the cost of being wrong, and every trader is wrong sometimes, the best ones included. A large loss is something much more serious, because it takes a very large profit just to get back to where you were, and in the meantime your ability to trade effectively is severely compromised by the reduced capital you are working with. One of the most personally revealing parts of the book is the section where Livingston describes a period in which he was essentially forced out of the market by his financial circumstances and had to find a way to get back in. He had been through a particularly devastating run of losses and found himself not just broke but in debt, owing money to brokers and creditors who had extended him credit during his trading operations. This was a humiliating position for a man who had been regarded as one of the most powerful operators on Wall Street, a man who had once been worth many millions and had lived in a style that few people in the world could match. He had to negotiate with his creditors, to arrange settlements and repayment plans, and to find people who would extend him enough credit to get back into the market and rebuild. He described this period not with self-pity but with a kind of resigned clarity, acknowledging that it was the natural consequence of mistakes he had made and that the only path forward was to correct those mistakes and start over. What is striking about this section is the dignity with which he faced the situation. He did not blame the market or the people who had given him bad advice or the brokers who had miscommunicated his orders or any of the external circumstances that had contributed to his downfall. He accepted that the fundamental responsibility for his situation lay with himself, that his errors of judgment and discipline had brought him to this point, and that only by correcting those errors could he hope to do better in the future. This is a quality that separates the truly serious and reflective person from the person who remains permanently trapped in a pattern of failure and blame. The person who can honestly say I was wrong and I understand why and I know what to do differently is the person who has a real chance of improvement. The person who attributes every loss to external causes and never examines their own role in the outcome is condemned to repeat the same mistakes indefinitely. Livingston became, over the course of his career, one of the most skilled and powerful traders of his generation. He developed what he called a feel for the market, an intuitive sense built up from thousands of hours of observation and study that allowed him to make rapid judgments that often proved correct even when he could not fully articulate the reasoning behind them. But he was very careful to distinguish this intuition from guessing. It was not the same thing as acting on a hunch or a feeling of optimism or pessimism unconnected to any real observation. It was rather the internalization of a large amount of knowledge and experience to the point where certain patterns and signals could be recognized and acted upon almost automatically, without going through a conscious and deliberate analytical process each time. A musician who has practiced for many thousands of hours does not consciously think about where to put each finger when playing a piece of music. The knowledge has become embedded deeply enough that it operates below the level of conscious thought. Livingston's market intuition worked in a similar way, and he spent a large part of his career trying to develop and refine it further, always paying close attention to the moments when it was right and equally close attention to the moments when it was wrong, trying to understand the difference. He talked about the importance of knowing when to be aggressive and when to be patient, and this distinction was at the heart of his approach to trading. There were moments when the market was in a clear trend, when the evidence was overwhelming and the opportunity was obvious, and those were the moments to put on large positions and be willing to hold them through normal fluctuations. There were other moments when the market was confused and directionless, when the signals from the tape were contradictory and no clear trend had established itself, and those were the moments to stand aside, to do nothing, to accept that the right trade was not yet available and to wait until it was. The ability to distinguish between these two types of market conditions and to respond appropriately to each one was, in Livingston's view, one of the defining characteristics of the really successful trader. Most people traded all the time, whether conditions were good or bad, because they felt the need to be active, the need to be participating, the psychological discomfort of simply watching without doing anything. Livingston learned at great cost that the times when you should not trade at all are at least as important as the times when you should, and that the discipline to recognize those times and stay out of the market is actually one of the hardest and most valuable skills a trader can develop. He also had a great deal to say about the social world of Wall Street and the way that the culture of speculation affected the people who participated in it. He observed that money and the pursuit of money brought out both the best and the worst in people. He had seen men of great intelligence and ability destroyed by their greed, by their inability to stop once they had enough, by the addiction to the game that made it impossible to simply take their winnings and go home. He had seen men lose their entire fortunes not because of bad analysis or bad luck, but because they simply could not make themselves stop trading, could not turn away from the excitement and the action even when rational judgment told them clearly that they had made enough and that the risks of continuing were greater than any additional gains they might realistically expect. The market, he suggested, had a quality that was genuinely addictive for certain personalities. The combination of intellectual challenge, financial stakes, rapid feedback, and the ever-present possibility of a big win created a psychological environment that some people found impossible to leave voluntarily. They would tell themselves they were just making one more trade, one more correction of a recent loss, one more attempt to catch a big move, and before they knew it, they had given back everything they had gained and more. He was honest enough to admit that he himself was not entirely immune to this trap. He had held positions longer than he should have, had re-entered markets he had successfully exited, had made trades that were driven more by the desire to be in the game than by any solid analytical reasoning. These were among his most costly mistakes. The sections of the book dealing with his great short-selling operations against the market during the financial panic years are particularly vivid and instructive. He describes the process of building a large short position very carefully, the importance of not revealing your intentions through the way you trade, the need to have enough capital to maintain the position through the inevitable rallies that interrupt even the most powerful downward trends. He also describes the pressure he faced from those who accused him of causing the very decline he was profiting from, of being a wrecking force in the economy who was making money by destroying the wealth of others. He responded to this criticism with what seems like genuine conviction. He argued that a bear market was not caused by short sellers, but by the overvaluation and overextension that had built up during the preceding bull market, and that short sellers were actually providing a useful service by pointing out that reality and helping prices return to levels that reflected genuine value rather than speculative excess. This is an argument that economists and market participants continue to debate, and Livingston presented one side of it with skill and passion. What is clear is that he believed what he said, that his short-selling operations were not destructive but corrective, not the cause of financial pain, but rather the identification and amplification of pain that was already built into the system by previous excesses. There is a section near the middle of the book that deals with Livingston's experiences trading cotton, and these pages are among the most detailed and concrete in the entire book in terms of practical trading methodology. He describes how he studied the cotton market carefully before putting on any large position, gathering information about the size of the crop, the condition of the weather across the cotton-growing regions, the level of demand from mills, the amount of cotton in storage, and any other relevant facts he could find. He describes how he had reliable sources of information about crop conditions in various states, men in the field who could give him accurate and timely reports about what the real situation was on the ground, rather than what the official report said or what the rumors in the market suggested. This emphasis on getting primary, direct information rather than relying on secondhand reports and rumors was very characteristic of his approach. He believed that real knowledge, the kind that was actually reliable enough to trade on with confidence, was hard to come by and required real effort to obtain. Most of what circulated in the market as information was actually noise, opinion, rumor, speculation, and deliberate misinformation. The trader who could distinguish the real signal from this enormous amount of noise was at a massive advantage over the trader who could not. After his cotton trading experience, he moved back to the stock market and continued his career through some of the most volatile and consequential decades in American financial history. He traded through the boom years of the early 20th century, through the financial panics of 1907, through the period leading up to and through the First World War, and eventually through the great bull market of the 1920s. Each period had its own character, its own particular blend of opportunity and danger, and Livingston adapted to each one, though not always smoothly or successfully. The war years created some particular complexities for him, because the disruption to normal economic life created both large opportunities and large uncertainties, and the government's involvement in markets was greater than anything he had experienced before. He was cautious during this period in ways that he had not always been before, recognizing that the rules of the game were in some ways different when external forces as powerful as a world war were reshaping the economic landscape. The 1920s were a time of great optimism in America, a period of economic expansion and rising stock prices that drew millions of ordinary people into the market for the first time. Livingston observed this phenomenon with mixed feelings. On one hand, the flood of new money into the market created opportunities for the kind of large-scale operations he had always specialized in. On the other hand, the irrational exuberance of the crowd, the way that stock prices kept rising not because of any sound fundamental analysis, but simply because everyone believed they would keep rising, reminded him uncomfortably of past booms that had ended in devastating crashes. He was not entirely comfortable with the direction the market was taking, and this discomfort informed some of the trades he made during this period. He had learned from long experience that booms always end, that the higher prices rise above their fundamental value, the harder and more painful the eventual correction will be. The market of the 1920s was, by the standards he had developed over decades of observation, running very hot indeed, and the rational part of his mind was always warning him to be careful even while the speculative part was drawn to the extraordinary opportunities that the rising market seemed to offer. Throughout all of these specific trades and operations, the book maintains its focus on the larger themes that give it its enduring importance: the psychology of trading, the discipline required for success, and the eternal conflict between what a person knows they should do and what they actually end up doing when real money and real emotion are involved. One of the most powerful and memorable passages in the book comes when Livingston reflects on the fundamental nature of market behavior and why it never really changes. Even as technology and regulations and the specific stocks being traded all change dramatically from one generation to the next. He argued that because markets are driven by human nature, and because human nature does not change on any timescale that matters for practical purposes, the fundamental patterns of market behavior repeat themselves endlessly. The specific circumstances are always different. The companies involved are different. The external events triggering movements are different, but the underlying pattern of boom and bust, of excessive optimism followed by panic, of prices rising far above value and then falling far below it, repeats itself in every generation. The people who understand this, who study the history of markets with genuine attention, can recognize the current moment in the context of past patterns and trade accordingly. The people who do not understand it, who believe that this time is different, that the current boom is real and lasting, and that the old rules do not apply anymore, are those who walk into every bubble with confidence and walk out broke on the other side. Livingston was also thoughtful about the role of information in markets, about the way that what appears to be breaking news is often not really new at all to the people who pay close attention. Major events in business, in economic conditions, in the affairs of companies, rarely happen without warning to those who are watching carefully. There are usually signs long before the announcement, patterns in the price action, unusual trading volume, subtle shifts in the behavior of insiders and knowledgeable parties that tell an attentive observer that something important is building. The tape, read carefully and knowledgeably, could often tell you that something significant was coming before the news was publicly announced, not because of any illegal access to inside information, but simply because the behavior of prices in advance of major events carries its own signal. He describes specific examples of this phenomenon, moments when he noticed unusual price behavior that told him something important was about to happen, moments when he acted on that signal and was proved correct. He was careful to distinguish this kind of legitimate observation from actual insider trading, and he believed that the information available in the tape to anyone who was willing to learn how to read it properly was enough to build a genuine trading edge without ever needing access to confidential information. The book also has a good deal to say about the practical side of actually executing large trades in the market, about the difficulty of putting on or taking off a very large position without moving the price against yourself in the process. This is a problem that ordinary traders with small positions never have to think about. If you want to buy 100 shares of a stock, you simply place the order and it is executed almost instantly at very close to the current price. But if you want to buy 100,000 shares or 1,000,000 shares, the act of buying itself pushes the price up because you are suddenly a very large buyer in a market where the supply of available sellers is limited. You cannot simply walk in and buy everything you want at once. You have to build the position gradually, sometimes over days or weeks, buying at the moments when the market provides natural liquidity without your purchases distorting the price too badly. Similarly, when you want to exit a large position, you have to do it carefully and gradually, because the act of selling a very large amount of stock pushes the price down, reducing the value of the position you still hold as you try to exit. This is one of the reasons why very large traders operate under constraints that smaller traders do not face, and why the strategies that work for an individual investor are not directly applicable to a fund manager or a large-scale operator. Livingston described these practical difficulties with considerable candor and detail, and they add an important dimension to the book for anyone who wants to understand what trading at a professional level actually involves. Beyond the technical aspects of trading, the book is also a deeply human story about a man trying to find a place in the world that suits his particular combination of gifts and limitations. Livingston was born with a remarkable gift for numbers and pattern recognition, and he found in the stock market an arena where that gift was genuinely valuable. But he also had human weaknesses, the desire for approval, the susceptibility to flattery, the difficulty of saying no to people he liked or admired, the tendency toward overconfidence after success. These weaknesses cost him dearly over the course of his career, and the book does not try to hide them or minimize them. One of the most honest things about this book is that it does not present Livingston as a hero without flaws. He made genuine and serious mistakes, he repeated some of them, and he sometimes failed to apply the lessons he knew he had learned. He describes all of this without excuses, with the kind of unflinching self-assessment that is genuinely rare in any memoir or biography. The book is also a window into a world that no longer exists in quite the same form, the world of early 20th century American finance, with its bucket shops and pool operators and stock pools and bear raids, with its lack of regulatory oversight and its tolerance for manipulation that would be criminal today. But many of the human dynamics it describes are timeless because they are driven by aspects of human nature that have not changed at all. The mixture of greed and fear that drives market behavior is exactly the same today as it was in Livingston's time. The tendency of crowds to get swept up in collective optimism during a boom and collective panic during a crash is just as strong today as it was 100 years ago. The difficulty of maintaining discipline and following a sound trading plan when emotions are running high is just as real now as it was then. This is why the book has remained in print for over 100 years, and why it continues to be recommended as essential reading by professional traders and investors all over the world. It is not a textbook with a set of rules to follow mechanically. It is a story told in the first person by a man who lived through extraordinary experiences and reflected on them with honesty and intelligence. The lessons it contains are not delivered as instructions, but are embedded in the narrative, revealed through the consequences of the choices the protagonist made and the quality of the analysis he brought to understanding those consequences. One has to read it as a thoughtful person, drawing the lessons out for oneself rather than simply looking for a checklist to copy. That is probably the right way to read any book that is genuinely worth reading. The market, as Livingston described it, is ultimately a mirror. It reflects back to you who you are, what you believe, how you think, and how well you can control yourself under conditions of stress and uncertainty. The person who is self-aware, disciplined, patient, and honest with themselves will find over time that the market rewards these qualities. The person who is self-deceived, undisciplined, impatient, and prone to blaming others for their own mistakes will find that the market punishes these qualities with a consistency that is almost mathematical in its precision. The market does not care about your intentions, your effort, your desire to win, or your financial needs. It simply responds to the reality of supply and demand, and if your actions and decisions are not aligned with that reality, it will take your money away from you without hesitation. There are many passages in the book that deal with the emotional experience of being in a large trade, of watching prices move and feeling the full psychological weight of the money at stake. Livingston described what it feels like to be short a large amount of stock in a rising market, to watch prices moving against you day after day, to face the social and financial pressure to cover your short and admit you were wrong, and to have to hold on to your conviction that the eventual decline is coming, even though you cannot know exactly when. He described what it feels like to hold a large winning position, to watch profits accumulate, to feel the temptation to take the profit before it disappears, and to have to discipline yourself to stay in the trade because your analysis tells you the movement still has much further to go. Both sides of this experience, the long, agonizing wait through adversity and the equally difficult discipline of staying in a winner, require the same fundamental quality, which is the ability to act on your own best judgment rather than on your emotions or on the opinions of others. This quality cannot be taught directly. It can only be developed through experience, through many repetitions of the same pattern under real conditions with real money at stake, through the kind of costly education that Livingston described throughout the book. That is why he said that there is nothing like losing all you have in the world for teaching you what not to do, and that when you know what not to do in order not to lose money, you begin to learn what to do in order to win. The sequence is important. First, you learn what not to do. That lesson is usually taught by the market through painful losses. Only after that foundation has been laid, after you have internalized in a deep and personal way the cost of the mistakes that are most common and most dangerous, can you begin to build on top of it the positive knowledge of what to do. The positive knowledge is the easier part to acquire in some ways. There are books, there are teachers, there are observations you can make of successful people and their methods. But none of that positive knowledge is really usable until the negative knowledge, the deep experiential understanding of what not to do, has been built through actual experience. This is one reason why most people who read this book, even those who read it very carefully and understand it intellectually, still make many of the mistakes Livingston describes. Reading about a mistake is not the same as having lived through it. The emotional reality of the situation, the fear of being wrong, the hope that things will recover, the pride that resists admitting a mistake, these things are not fully present on the page in the way they are present in the moment of the actual trade. Livingston understood this and was not suggesting that reading his book would automatically make anyone a successful trader. He was rather offering his experience as a way of at least reducing the number of times a thoughtful reader would have to pay for a lesson that Livingston had already paid for. If even one error could be avoided, or recognized more quickly because of something the reader had understood from the book, then the book was worth reading. The sections of the book dealing with market manipulation and the behavior of large operators offer a particularly interesting perspective for modern readers. Today, the kinds of operations Livingston describes, coordinated pools to move stock prices, deliberate spreading of false information through financial media, trading on information that ordinary investors do not have, are all either illegal or heavily regulated. But the underlying human dynamics that made these operations possible and profitable in his time are not illegal and cannot be regulated away. Large institutional investors still move markets through their buying and selling. Rumors and misleading information still circulate in financial media, often in forms sophisticated enough to avoid legal prohibition. The gap between what powerful and well-informed parties know and what ordinary investors know is still very real, even if the regulatory framework now makes it harder to exploit that gap in the most obvious ways. The lesson Livingston drew from his experience with manipulation and misinformation was not primarily a moral one, though there was a moral dimension to it. It was a practical one, namely that the ordinary investor or trader is operating in an environment where powerful forces are sometimes working against their interests, and that awareness of this reality is an essential part of protecting yourself. You cannot assume that the information you receive through normal channels is accurate, that the apparent strength of a stock represents real demand rather than manufactured buying, or that the consensus opinion of the financial press reflects real knowledge rather than organized propaganda. The appropriate response to this reality is not paranoia, but skepticism, a healthy habit of checking apparent facts against the behavior of prices and asking whether the story you are being told is consistent with what the tape is actually telling you. If a stock is being talked up by all the financial newspapers, but the tape shows persistent selling by large, well-informed parties, something is wrong with the story you are hearing, and the tape is telling you the truth while the words are telling you a lie. Livingston also devoted considerable attention to the question of what makes trading different from investing, though this distinction was not as clearly defined in his time as it sometimes is today. He was unambiguously a speculator and a trader, not an investor in the sense of someone who buys stocks intending to hold them for many years while a business grows and creates long-term value. His time horizons were shorter, and his approach was more tactical, more focused on the immediate price behavior of stocks and on the conditions of the broader market than on the long-term prospects of individual companies. He respected both approaches, but he knew his own nature well enough to know that the patience required for long-term investing, the ability to hold a position for years through all the ups and downs of the market cycle, was not something he possessed in sufficient quantity. He was built for action, for the constant engagement with the market, for the intellectual challenge of reading the tape and making judgments on shorter timescales. There is real wisdom in this self-knowledge. One of the most common and costly mistakes people make in financial markets is to adopt a style of trading or investing that does not match their actual temperament and psychological makeup. A person who has the patience and the analytical depth for long-term fundamental investing, but who is impatient with short-term fluctuations will make money if they stick to their approach and lose money if they try to time the market on short timescales. A person who has the quick judgment and emotional discipline for active trading, but who lacks the patience for the years of waiting that long-term investing requires will make money trading but lose money if they try to buy and hold through the inevitable periods when their positions are underwater. Knowing which approach suits you and having the discipline to stay within that approach, rather than switching between styles depending on what seems to be working right now, is a form of self-knowledge that most market participants never fully achieve. Livingston achieved it relatively early in his career, though not without considerable suffering first. There is a passage near the end of the book that deals with the loneliness of the trading life. The way that the demands of operating successfully in the market tend to separate you from ordinary social life. The trader who is fully engaged with the market must be willing to hold positions that are unpopular, to maintain views that most people around them consider wrong, to act on signals that the crowd does not see or does not believe, and to make decisions quickly and definitively in conditions of uncertainty. These requirements create a certain kind of isolation, because the fully engaged trader cannot simply go along with the consensus for the sake of social harmony, cannot share their position easily with friends who are not in the market, and cannot afford the luxury of prolonged indecision that ordinary social life often allows. Livingston felt this isolation acutely at various points in his career, and he was honest about it. The market, for all its stimulation and excitement and intellectual richness, was ultimately a solitary pursuit. You stood alone in your judgment, alone in your trades, alone in your losses and your gains. The market did not care about you. It did not reward loyalty or effort or intention. It only responded to whether you were right or wrong, and the only person who could be responsible for that was you. This is one of the aspects of trading life that attracts certain personalities and repels others. For some people, the absolute clarity of the feedback, the fact that the market tells you every day in the most direct possible way whether your analysis is correct or incorrect, is deeply satisfying. There is no ambiguity, no politics, no favoritism, no need to manage other people's perceptions of you. You either make money or you lose it, and the responsibility is entirely yours. For other people, this same absolute accountability is terrifying because there is nowhere to hide, no way to attribute failure to factors outside your control, no social cushion to absorb the impact of being wrong. Livingston was clearly one of those personalities for whom the absolute accountability of the market was a form of liberation rather than a burden. He could not have survived and thrived for as long as he did in an environment so hostile to pretense and self-deception if he had not been fundamentally comfortable with that kind of direct confrontation with reality. The book ends not with a triumphant conclusion or a neat summary of lessons learned, but rather with the impression of a life still in progress, still full of uncertainty, still subject to the same fundamental challenges that had defined it from the beginning. This openness is appropriate, because the message of the book is not that success in the market is achievable once and then permanent, but rather that it is always provisional, always subject to the next challenge, always requiring the same discipline and honesty and willingness to learn that it required from the very beginning. There is no graduation from the school of the market. There is only the ongoing work of staying awake, staying honest, staying disciplined, and continuing to learn. Livingston, for all his great successes, never stopped paying tuition. And that is perhaps the most important lesson of all. The understanding that the market is a lifelong education with no final exam, no diploma, and no guarantee that what worked yesterday will work tomorrow. The person who approaches it with that understanding, with genuine humility alongside genuine skill, is the person who has the best chance of surviving and eventually prospering. The person who believes they have finally figured it out, that they have mastered the market and can now operate on autopilot, is the person the market is waiting to teach another lesson to. This warning runs through the entire book like a thread, woven into every story of success and failure, every insight, and every mistake. It is why the book remains as relevant today as it was when it was first written, because the human nature it describes and the warnings it contains are as applicable now as they were in 1923. The stocks are different, the technologies are different, the regulations are different, The speed of information flow is incomparably faster, and the scale of the global markets dwarfs anything that existed in Livingston's time. But the people trading those markets are the same kind of people they have always been, with the same strengths and the same weaknesses, the same desires and the same fears, the same tendency to hope when they should be selling and to fear when they should be buying. And as long as that is true, which is to say as long as human beings are the ones making the decisions in financial markets, the wisdom of this book will continue to be relevant and worth reading. Edwin Lefèvre gave the world something genuinely valuable when he published this book, a deeply honest, psychologically astute, and practically wise account of what it means to live inside the financial markets, to make them your arena and your livelihood, to be tested by them every day, and to come back the next day and be tested again. It is a book that rewards careful reading, that reveals new layers of meaning with each rereading, and that speaks to something fundamental about the nature of human striving, human error, and the hard-won wisdom that can sometimes emerge from both. The story of Larry Livingston, which is to say the story of Jesse Livermore, is ultimately not just a story about stocks and money. It is a story about a person trying to understand themselves well enough to operate effectively in a world that is often irrational, sometimes dishonest, and always unforgiving of self-deception. That is a story that belongs to every person who has ever tried to do something difficult, who has ever faced repeated failure and had to decide whether to give up or go back and try again with better understanding. The specific arena is the stock market, but the human drama is universal. And that is why, more than a century after it was first published, Reminiscences of a Stock Operator remains one of the most read and most recommended books in the world of finance, and one of the most honest and instructive accounts of the relationship between human nature and the pursuit of success that has ever been written.